hopefully I can explain this, the fundamentals for you to better understand when you're buying and selling a poor man's covered call, why you go about making sure the width of the strikes are covered. So first off, you understand what calls and puts are. The strike prices, when I mention strike prices, I'm talking about your long and your sold or whatever. So if I say we're looking at SPY, we're looking at the 6/12 time frame, and I say look at the 145 strike price, that means you're looking at over here, the strike, meaning you're going to be messing with the SPY at this range, 145, 150, 155, so on and down the line. Remember, strike prices are always lowest to highest on the options table. So if I say let's look out 2 years or 600 and some days, and we want to look at anything above a delta of 80, because remember, if we buy this thing at 200 for $10,000, for every move up that the SPY goes, we're going to make $85 plus your gamma if there is any, but as you can see, there's none for SPY out this long. Okay, so that's that. When you're looking at the 200 strike price or whatever I mentioned, we want to make sure, remember there's a couple of rules. We're not paying more for the contract. So this is $10,000, right? 10,000. We're not paying more for the contract than the strike price. And why is that? Because you're not going to go pay a contract for a $100,000 house for $150,000, right? Why would you? I'm not going to pay more for something if it's only valued at a certain price. So, guess what? SPY is at 294 as of today, and in hindsight, or what we're looking at, is this position. So I'm not going to pay any more than $20,000 for this contract. The cheaper that I pay, it can be paid off sooner by selling those covered calls. So, again, we do not want to pay more for the contract than the actual value of this strike price. Remember, one contract, 100 shares. So we had times 100 by the 200 here, and that gives us 20,000. So this thing cost us 10,000 today if we was to get into it. I click on that. I hit confirm and send. Now here's what I want to show you, okay? I was always doing it the math way, but this is going to give you your break-even strike price, and I know you still don't you really don't understand this. Is why this is saying break-even stock price. Okay. When you pay for this call, say for instance you're paying, right? You're paying 10,000. I'm gonna try to write straight for you. You're paying 10,000 for the 200 strike price. Once you pay the 10,000, that's gone. The 10,000 is gone. You paid for it. The only other option that you have later on is hopes that it goes up in price and becomes 11,000, 12,000, and so on, right? But if it goes down in price, if the SPY drops, this 10,000 is going to lose value. And so on down the line. So you can buy it back either cheaper, or sell it for cheaper, and take a loss that way. Or if the SPY continues to go up, this 200 strike price and this contract will now be worth 1, or 1,000 more, 2,000 more, so on and so on. You can sell this off and make money. But what are we doing when we're buying these contracts? Remember, this is used for buying shares cheaper. So you're paying $10,000. That's a debit for this 200 strike price. The SPY is at 294, and you're paying $10,000 to get into this one. So that means at the end of expiration, you have the right, but not the obligation, to pick this thing up for 200, regardless of where the SPY is at expiration. If it's more in price than 200, guess what you're going to do? Of course you would want it. If it's lower than 200, you walk away and you just give up your $10,000. Remember what we talked about real estate contracts. In 5 years, a house is going to be available on the market for $200,000. An investor who knows real estate options contracts will go and tell the contractor, hey, I'll give you $20,000 today and buy this house off of you for $200,000. So you pay $20,000. So at the end of the 5 years, if the market goes up and the house is worth, say, $500,000, you have the right to buy, but not the obligation to pick up the house for $200,000. So what you would do is, you already spent $20,000. You would give that contractor who owns this house the remaining balance. So now you're in a house that is on the market, or that you have for $200,000, and you can sell it on the market for $500,000 for a $300,000 profit, or $300,000 profit. So back to stocks and options. You're buying this contract to get in a 200 strike price, regardless of where the price is. If it's still at 294, all right. Well, now you only have to give up another $10,000 to get in at 200. And you can sell it on the market for 294. But there's a couple things that you can do. Remember, as a call buyer and a put, I'm not even going to tell you about puts yet, but as a call buyer, you have the right, but not the obligation to buy the shares. As a call seller, guess what? You have the right to sell, but you also have the obligation to sell that, because you already sold this contract as a option seller, or an option contract seller on the call side. You have an obligation. The person on the buy side can walk away, or they can, what we call, exercise that right to buy, and the seller of that call option contract has to sell. They have the obligation. You can't, as a seller, walk out of that contract. Before expiration, what you can do as an option seller, you can buy it back for a cheaper price and pick up premium. That's it. If the stock was to plumble, guess what the options, this 10,000 is going to do? Remember, it's going to go down. So this seller can buy it back for a $1,000 profit, $2,000 profit, or $3,000 profit, and so on and so on and so on, depending on how far the SPY drops. That's as an option seller. You sell premium up front and say, okay, I'll let go of my shares at 290 or at 200 if the call option buyer exercises that right. So why would they exercise that right? Remember, as a buyer, you would exercise it if it goes all the way up to 294. This is where sellers would lose if the stock price goes against them. So I'm selling at 200, saying if the stock, I want the stock to drop or stay under 200. If it goes above 200, I let go as an options seller at that strike price. And remember, in the market, there's a thing called covering, or basically you own assets to cover it, and that's where we're going to get into the covered call writing, because you're covered. You have assets that you own, 100 shares or more, that you can write options contracts on, or covered calls. This is what we call a covered call writer. As a call option seller, you either have assets or you write naked. And guess what? That comes with risk, because then you have to cover what it would to sell off or let go of 100 shares. So your upside potential is substantial. So you're writing a contract naked. You don't have any shares. So your broker is going to say, you got to come up with the money to give that person at the 200 if the stock goes up more than 200. So the poor man's covered call. So poor man's covered call is, instead of having 100 shares, all we're doing is we're buying way out in expiration a call and then selling a call against it. So back to what the most difficult thing to understand is, where do you get these break-even prices? Well, if I'm paying $10,000 for this 200, that's gone. That's paid for. If we're selling 35 to 45 days, another call against the one that you bought, or that contract that you bought, and it shoots up in price above that strike price, you have to let go of those shares. So what your broker is going to do, they're going to assign you 100 shares at 200. You already paid 10,000. So the total value is 20,000. But you have to add on the 10,000 because you paid for this. So that's now 30 30,000 divided by 100 is 300. So we have to look at the 300 strike price now to cover this, because we want to break even. We want to say if we're going to write an option against this, worst case scenario, if this thing explodes up, I'm going to have to let go at 20,000 plus my 10,000 gives us my break even, which is 30,000. So I have to sell premium anywhere from 300 and above. So if I'm paying 10,000 here, it tells you, the system tells you 301.97, because I'm paying a little over 10,000 right here. I'm paying an extra 197 bucks. So it tells us the max loss, which remember, anything you buy is the max loss. When you're selling, it's a little bit different. But 10,197. So our break-even stock price, which means the least that I want to probably sell premium at, is 301.97. If I sell under, I'm risking letting go of my shares for cheaper than the broker's going to assign me, and I'm selling off to someone else. Because remember, what you write this contract at, this 300 or 301, you're writing that contract and saying if the stock price goes up above that, you have the obligation to let go of your shares, which you're covered, at 300. So your broker is going to assign you the 200 or the 200 strike price shares, and then sell at 300 strike price shares. So we're going to look at the 42 days. We know that by going the further out from expiration, we start picking up a little bit more premium. We also understand the theta, or time decay curve, starts kicking in around 30 days. So that's where we can buy this thing back a lot cheaper. Okay, so for $10,000, we're looking at the 300 strike price, 301. That's break even. And we can sell this thing for $5.43. That's $543, because everything acts in every one contract is theoretically 100 shares. So $590 we can sell this thing for. So if we do our math, 590 divided by 10,197, for which we paid, we're making 5.7% in 42 days. We do that month after month. It's not really going to be 12, but let's just do 10. We get a 57% return every year. Wow. Just off this one strategy. So, I hope this helps when I always stress, make sure you cover the width of your strike prices. And the width of your strike prices is going to be the strike price that you buy. So again, we're buying the strike price at 200 for 10,000, and then we're selling at the strike price of 301. Whatever strike price you buy. Let me show you one more example. Say I'm looking at a different strike price other than 200. I'm looking at 150. I have to pay 14,000 for this thing. Just a little under if I could just buy this thing outright. So that means if I buy this for 14,000, I have to add on to the 150 right here, which would give me 29,000, because my broker is going to say, okay, we have to assign you at 15. You already paid 14,000. Got to add on that because you have 100 shares, plus the width of the strike price is going to give us that 29. So then we'd go back up to 31 days or 35 to 45 days and sell at least at the 290. But I also don't want to pay more if in hindsight or theoretically the I guess future value would drop down to 15, because I could just buy SPY at 15,000 for 100 shares instead of overspending. So I always like to at least get this thing in half. But sometimes these prices are more because you're paying way cheap. You're getting that way in the money price, and more than likely SPY won't drop down to that much. But even if it does, I don't really want to pay 18,000 for $11,000 position, because it's going to take more money to make up that. And plus I have to go up still to 18,000 plus the 11,000. It still puts me around the 29 to 29 and a half to 295 to 300 strike price. So I'm paying $18,000 and only making, what did we say, like 500. So my margin's dropping. So I'm going to stick around deltas of 80s and see what I can get. Here's 170. Okay, here's 170 for 12,000, probably 12.5. So we have to add on the 12.5 because we're paying for this, and the 170. So if we go in here and I hit buy, it's going to tell us our break-even price, 298.17. So if I buy this for 12,000, I do not want to go under the 298. I want to look at 299.300. That's going to be my for sure premium, regardless of what this price does. It could shoot up. I know my break-even's covered. That's why we added our original debit paid in our strike price, and we're going up to this next strike price in case it gets called away from us. And we're making these premiums now. I'm making 600 bucks. This thing shoots up all the way up to 400. I'm still making 600 bucks. The shares get called away from me at 300. I've got the asset back here covered at the what I said the strike price was, 170, 180ish, and I'm making 600 bucks. So that's how that works. If you've got any questions, as always, reach out. And this video is going to be stored in your file. And if I post this up in the group, I hope this explained the poor man's covered call. Instead of going out and buying the SPY right away for 29,000, we're going to go write an option contract. And so the risk comes with options is simply this: you're paying cheaper, you're buying cheaper for this same position, but it comes with a price. And what is that risk or price? It expires. Unlike if I bought the SPY today, I can hold on to those shares forever. But with options, they expire. They're cheaper, they can make you the same return, but guess what? They come with that risk of expiring worthless. So it has to work in your favor. So That's it for this video. I hope it helped explain the poor man's covered call. And as always, don't hesitate to reach out. Thank you.